Hey everyone, welcome to This Explainer. Today, we're going to put Vodafone's frankly highly contradictory financials through an intense, systematic obstacle course to uncover what's really going on. You know that feeling when you look at a company's numbers and it's like they're telling you two completely different stories at the exact same time? Well, if you've ever felt that way, you are in the right place. Let's dive right into the ultimate valuation gauntlet.
Okay, let's quickly map out our gauntlet for today. We're hitting the Vodafone paradox, running the valuation gauntlet, checking out the media blackout flags, doing a guru reality check, and finally getting to our final verdict, value or trap.
All right, starting off with part one, the Vodafone paradox.
So, take a look at this number, negative 289 million euros. That right there is their trailing 12-month net income. It's a severe gap loss that basically makes traditional earnings metrics like your standard trailing PE ratio completely meaningless. Honestly, if you only looked at this one specific figure, you'd probably think the company was in absolute freefall. But then, we flip the page and see this number, 14.29 billion euros. I mean, how on earth does a company pull that off? Despite that massive gap loss we literally just looked at, Vodafone generated a staggering 14 billion euros in operating cash flow during that exact same trailing 12-month period. So, it begs the question, how do you even begin to value a business that loses millions on paper but prints absolute billions in actual cash?
Well, that brings us right to part two, the valuation gauntlet.
Let's kick this off with our Group A cash flow models. These are based on standard WAC and levered flows, and right away, we see an intrinsic value range clustering firmly between $17 and $28 per share. Whether we're looking at a standard discounted cash flow, unlevered free cash flow, or adjusted present value that factors in interest tax shields, the sheer scale of that massive cash generation pushes the stock's implied value way above its current trading price, which sits around $16 right now.
Now watch what happens when we switch gears to the Group B dividend and income models. Wow, they severely punish the stock for those gap losses. Because models like the residual income model and economic value added rely so heavily on operating profit and book value, those negative earnings drag the calculated value all the way down into the $8 to $15 range. It is a wildly stark contrast to what we just saw with the cash flow models. But wait, the story flips completely again when we move to Group C. If we compare Vodafone to European telecom peers, think BT or Orange, using standard multiples, the stock suddenly looks deeply discounted. Just look at enterprise value to EBTR. Vodafone trades at just 4.36 times, while the sector average is way up there around 6 to 8 times. Because of that, the projections shoot anywhere from $18 all the way up to $30 per share.
Okay, moving right along to Group D, the balance sheet models. If we look strictly at the hard assets, the book value gives us a tangible floor of $12.64 per share. But Telecom is notoriously asset-heavy, right? So if a competitor wanted to physically rebuild Vodafone's entire pan-European and African network today, what we call the replacement cost, that model suggests a true value somewhere between $18 and $28.
Finally, rounding out our gauntlet in Group E, we have to factor in advanced real options. Because Vodafone isn't just traditional mobile plans anymore. They have this massive African fintech engine called M-Pesa, plus ongoing 5G expansion and some potential M&A optionality. When we actually factor in these catalysts, it tacks on an extra $3 to $8 of option value to our base models, pushing the absolute top-end potential all the way up to $32.
Moving on to part 3, the media blackout flags.
So, the really crucial point here is that behind those sunny adjusted EBITDA headlines that companies love to promote, we are seeing some severe red flags that fly completely under the radar. Net debt has actually ballooned to over 25.4 billion euros. And get this, their dividend payout ratio is over 100%. That means they are basically paying dividends out of borrowed money or cash reserves. Plus, return on equity is virtually zero. Just 0.11%, and their operating margins are visibly getting compressed.
When you actually visualize the sheer weight of that balance sheet risk, it's pretty staggering. Look at this. You've got 54.45 billion euros in total gross debt, stacked ominously against just 14.58 billion in cash. This is a highly leveraged infrastructure play. And let me tell you, in a high interest rate environment, that massive slice of debt acts like a seriously heavy anchor.
On the flip side, the green flags we uncovered are incredibly potent. Remember that absolute fortress of 14 billion in operating cash flow we talked about?
Well, it completely covers the dividend. On top of that, you've got those deeply discounted valuation multiples, a super low volatility beta of just 0.33, and, this is huge, a totally underappreciated high-margin fintech business in Africa. M-Pesa boasts over 92 million customers. There is some serious value here, just hiding in plain sight.
All right, let's hit part 4, the Guru reality check.
Let's start by bringing in the heavyweights, the fathers of value and growth investing. Both Ben Graham and Peter Lynch wouldn't just pass on this stock, they'd probably run for the hills. For Graham, the negative trailing earnings combined with a crazy high forward PE ratio of nearly 36 just totally breaks his strict defensive rules. And for Lynch, the PEG ratio fails spectacularly, simply because Vodafone's 2 to 4% growth is nowhere near fast enough to justify that multiple.
Okay, so what about the Oracle of Omaha himself? Well, Warren Buffett would definitely pass too. While he might actually appreciate the cash flow generation, that abysmal 1.52% return on invested capital falls spectacularly short of his 15% threshold. Add in that elevated debt-to-EBITDA ratio of 4.45 times, and it firmly fails his test for high-quality, efficient capital allocation.
You know, it's actually fascinating how perfectly Buffett's famous warning applies here. You should be very careful about buying a business with a lot of debt. That quote literally strikes at the very core of the Vodafone paradox. Because no matter how much cash a machine prints, a towering mountain of debt can always threaten to crush the equity.
And that brings us to part 5, the final verdict. Is it a value or a trap? Structurally speaking, our analysis shows Vodafone possesses what we'd call a narrow economic moat. It's heavily protected by massive infrastructure costs, which gives it efficient scale, and there are pretty high customer switching hurdles. The network effect is definitely real, but because telecom is largely a commoditized service these days, they really lack true brand pricing power and any definitive cost advantages over their main rivals. So, synthesizing all 21 of our models gives us a blended fair intrinsic value of about $18 to $20 per share. With the current market price sitting around $16, the math strongly indicates the stock is fairly valued to maybe slightly undervalued. It's like a tug of war. The asset and cash flow models pull the value up, while the dividend and GAAP earnings models drag it right back down. So what's the big takeaway from this explainer? It's that Vodafone is a classic cash flow machine with GAAP problems. The underlying numbers scream that this is a deeply discounted cash printing machine. I mean, 14 billion euros in cash flow is undeniable. But on the other hand, the remarkably low quality of those paper earnings, virtually zero return on equity, and that massive debt load should absolutely scream caution to anyone strictly following quality investing principles. We've laid out the entire valuation gauntlet for you, perfectly reflecting the data from our source analysis. So, I want to leave you with this final question. Is this a classic deep value turnaround sitting on 30% upside, just waiting for the broader market to finally wake up to the cash flow? Or is it a value trap, where GAAP losses and a massive mountain of debt are eventually going to catch up to it? Which side of this paradox are you on? Take this data, do your own homework, and let us know. Thanks so much for learning with us today on this explainer.